In the previous video we have shown that a rate of return is equal to the ratio of total return to total capital. So assuming the cost of capital is R, the rate of return can be computed in an easy way from the profits and the invested capitals. Now, in a one-period project we have only one income, and we divide it by the only capital invested at the beginning of the first period at time 0. If we have a two-period project, then we just have to add the second income discounted by one period and as for the capital, we just have to add the second capital invested in the second period discounted by one period. And if the project is a three-period project, we just have to add the third income discounted by two periods, and at the denominator we have to add the third capital C of 2 discounted by two periods, and so on until the last period. In the last period we have the last income discounted by n minus 1 period, and we have the last capital which remains invested in the project at the beginning of the last period, which must be discounted at the cost of capital by n minus 1 period. This is the rate of return of the project. We now show that this rate of return that we have called average internal rate of return is indeed an average, is indeed a mean. Then we delve into details of this mean. Now, to this end, we get back to the example we proposed in the first video. The two-period project with three dates: time 0, time 1, and time 2. Two incomes generated by the project at the end of the first period, 375, and at the end of the second period, 225. These incomes are generated by the capitals: 600 at the beginning of the first period and $400 which are invested at the beginning of the second period. Now, it is clear that we have two periods, two incomes, and two rates of return referred to single periods. In the first period, the project generates a rate of return, let's call it I of 1, equal to the ratio of 375 to $600, return divided by capital, and this is equal to 62.5%. In the second period, the rate of return, the holding period rate, is equal to the ratio of the income generated, 225, to the 400 capital, that remains invested. And this makes 56.3%. Now, the project rate of return, the AIRR, is simply the weighted mean of these one period rates, where the weights are the capital. The weights of the mean are the capitals invested. So just let us make the computation. Now the total capital invested in the project is given by the sum of the capitals invested. Now, given that the invested capitals differ by one period, we have to compute the present values of the capitals. So we sum 600 and the present value of the second capital that remains invested in the project. We remember that the cost of capital is 15%, and we get the total capital invested. The total capital invested is 947.8. Now we can compute the mean of the two holding period rates. The mean of I1 and I2 with the weight, we denote it by W1, W2. Now, how can we compute these weights? How do we compute the weights? The first weight is simply 600 divided by the total capital, 947.8, and this makes 63.3%. And the second weight is the present value of 400 divided by the total capital, 947.8, and this makes 36.7%. So we have the weight and we have the rates of return. 62.5% is the first rate of return, 56.3% is the second rate of return. We just have to multiply the weight by the respective rate of return and then sum. Let's make it. So the rate of return of the project, average internal rate of return, is 62.5% multiplied by the weight, 63.3%, plus the second rate of return, the second period rate of return, which is 56.3%, times the weight, 36.7%. So this is first rate, the first holding period rate. This is the second holding period rate, and we have multiplied it by the weight. This is the first weight, weight 1, and this is the second weight, weight 2. the result is exactly what we have obtained in the first video. The rate of return of the project is 60.2%. More generally, when we deal with a end period project, we can write that the rate of return of the project, the AIRR, is equal to the N holding period rate multiplied by the respective weight. The last summand is the last holding period rate multiplied by the last weight. The weight are measured as follows. The first weight is capital invested at the beginning of the first period divided by the total capital invested. The total capital invested is the present value of all the capitals invested in various periods. So C0 plus C1 discounted by one period plus C2 discounted by two periods, and so on, until the last capital invested at the beginning of the last period, C of n minus 1 discounted by n minus 1 period. We can also denote this total capital with the symbol PV, present value of the capital. And this is the first weight. Now the second weight is the present value of the second capital invested. So C1 is counted by one period divided by total capital, and we can use the new symbol present value of all the capitals. And the third weight is similar. The third weight is the second capital invested discounted by two periods divided by the total capital invested, and so on until the last weight Wn, which is the last capital invested, C of n minus 1 discounted by n minus 1 period, which is divided by total capital.